Hello and welcome to the Ethics and Professional Conduct for New York State CPAs. I'm Aaron Kofira, a partner in the Professional Excellence Division, and over the course of the next 4 hours I'll be presenting on this important topic. At a high level, the agenda is relatively simple. We're going to go through rules and regulations and independence rules that we often encounter within the practice. In order to obtain your CPE credit for this course, there will be a number of different caricatures and letters issued throughout the presentation. Upon completion of this course, you will have to go onto a separate system and input those individual characters and letters in order to receive your CPE. Future information will be provided in a separate email to walk you through this process in order to obtain your CPE. With that, let's get right into it. From introductions and backgrounds, it's definitely important to note that a lot of people have spoken on ethics in the past, including Albert Einstein himself, who said, "I do not believe in the immortality of the individual, and I consider ethics to be an exclusively human concern without any superhuman authority behind it." Basically, in a nutshell, this is just indicating that he viewed this as something that is pretty commonsensical, and there really isn't a lot of significant thought process behind it. It's just doing the right thing in all situations. Independence update. I know everybody has seen this definition before, and I know it's always talked about in the ANA update, and I know it's covered throughout the presentation today, and that's the definition of a covered member. And the definition of a covered member really holds true through all of the individual independence rules, from the AICPA to the SEC to the DOL, and then right down to the state of New York rules and regulations. And really, just going through it, I know we really never spend a lot of time going through it, so I kind of will in this time. What a covered member is, right? I mean, normally I throw the presentation or the definition up on the screen and say just make sure that you're aware of it. We include it in the annual confirmation process. So let's just spend a couple moments on it and really dig into what is a covered member. So if I look at the first bullet on here, the covered member is an individual on the attest engagement team. So if you are a staff member, first year staff all the way up to partner, and you sit on an audit, review, or compilation where we indicate we're independent, you are deemed to be a covered member as it relates to that specific engagement. So if you cannot own any stock or any sort of investment ownership in that entity. It's kind of goes without saying. A position to influence the attest engagement. So a lot of times that would probably cover somebody up the chain from a QC perspective, possibly. Generally, we will apply this rule to the compensation committee and the board as well, to deem them to be covered members to a certain extent, depending on the facts and circumstances. Partner equivalent manager provides non-attest services to the non-attest client of 10 hours of non-attest. So this is the 10 hours of non-attest services. So if you are providing bookkeeping services to the client, or like a non-attest service, you ultimately provide more than 10 hours, you're deemed to be a covered member as it relates to that service. Now, this is the interesting thing here is the partner equivalent. We will, as a firm, define principals as a partner equivalent. So that is very important to as the next bullet, because if you're a partner equivalent in the office in which the lead attest engagement partner practices, then as a result, you have to be independent of all the engagements in the specific office that you reside. So if you're a principal in the Albany office, you're deemed to be a covered member for any engagements that any of the Albany partners sign. Just jumping back to the non-attest service piece, that 10 hours is really the threshold. So you can, if you are covered, you're deemed to be a covered member once you provide more than 10 hours. Otherwise, you would not be. That being said, if you are, let's say, in the ERM practice and you're providing assistance and review of their internal computer system, that would deem you to be a covered member as part of the individual engagement team. The next two are a little bit, we don't see them as common, right? The firm including its employee benefit plans. So we will go through as part of the annual inspection or restricted stock testing, we'll look at the firm's employee benefit plan investments just to ensure that there are no investments or mutual funds where we may be impairing our independence. And then an entity whose operating policies can be controlled by any of the individual entities described in A through E. A above, which is really going into the specific codification. So it's really any subsidiaries that may consolidate into one of our clients, we would deem to be covered members of those if we had an investment in a sub. So the last bullet is very rare. I don't think we see it a lot. Generally, it's on a case-by-case basis. So that's kind of at a high level the overall independence rules and how they impact covered members. So again, as alluded to, just a reminder that the covered members cannot own restricted stocks or have loans with financial institutions. Here are the specific links to the restricted stock listing as well as our banking institutions. There are grandfather rules that are applicable when it comes to loans. So if you've had a loan for 20 years and we pick up a new credit union or a new bank, generally if it's your primary mortgage, then you would be grandfathered in and would not have to do anything with that loan. There are certain exceptions. You would not be able to change any of the terms or conditions or refinance that loan on a go-forward basis once it becomes a client. So if you are in the process of getting a home mortgage or taking out personal loans or items of that nature, I would suggest that you look at, again, the definition of a covered member to see if you are deemed to be a covered member as it relates to a specific engagement, as well as to taking a look to make sure that the financial institution, that you're not impairing the firm's independence. When it comes to these matters, you are always able to reach out to DL Team PED and on that distribution list, and we can definitely work through the specifics of what your issue is, just to make sure that the firm's independence is not impaired. So once you become a CPA, you're required to follow various rules and regulations, and these rules and regulations are captured in the New York State laws and regulations on this specific website located on this slide. There's two specific pieces that are important to point out. Part 29, which deals with really all professions and all professions' unprofessional conduct, as well as Section 29.10, which really relates specifically to CPAs. And 29.10 we'll get into in more detail as part of this presentation. But at a high level, this is kind of where the maintenance of work papers for 7 years comes from, the expressing of an independent audit opinion or any sort of opinion or any sort of report where we're independent is driven by those individual standards, as well as any kind of requests that we may receive for client work paper requests and ensuring that we're compliant with those. So for instance, if we're requested a copy of a tax return, that we're providing those and withholding those from one of our clients may be deemed to be a unprofessional conduct and may subject the firm as well as the individual to potential disciplinary actions. And again, as we go along in this presentation, we will get into further information surrounding those specific requirements under Part 20, Section 29.10. Another important piece of the being licensed within the state of New York is the New York State Education Law 6502. This really lays out the specific training requirements that are applicable to CPAs in order to maintain the license. So for instance, generally you hear of the 120 hours rules. This is the remaining 40 hours of CPE that are required for CPAs to maintain their license. This is 40 hours in each individual triennial period for 3 years for the total of 120. There is an additional possibility to get your CPE requirements of 24 hours specific to one subject area. The next piece, obviously, that everybody's here for is the 4 hours of ethics training. That is required as well as under the New York State laws and regulations for CPAs. For the 4 hours of ethics to be treated towards a concentration area, they need to be specific in an area. So this is a general ethics course. So if you are trying to meet the 24 hours, this ethics course probably is not going to be specific to any specialized areas or anything along those lines. It's just a general 4-hour course. There are Q&As that address a lot of the CPA questions that may come up for CPE requirements, and those are also included within Section 70.9 under the regulations of the Commissioner of Education, as well as in Section 7409 of the New York State Education Law. Overall, it's just important to note that CPAs must maintain good moral character. This just is in general, but this is also kind of at the heart of the overall laws and regulations for the state. Meeting the educational requirements as well as any CPE requirements are also key to the underlying profession. So a lot of times we're going to throw around in this presentation fraud and ethics, and we'll look at some case studies in the future. But I think it's important at the onset to really lay out what is the difference between fraud and ethics. And is there any sort of correlation between doing something that's ethical while you're committing fraud? And is that really a possible item within our guides to be able to do that sort of thing? We just take a step back and look at what Merriam-Webster and how Merriam-Webster defines ethics and fraud. I mean, it's pretty simple, and the definition is on the screen right now as to what ethics is. Ethics is obviously a study of good and bad behavior, and it might really what it ultimately comes down to is what's the correct thing depends on the situation, and also you kind of know it in your gut as to how you feel about something. If you know it's the right thing to do, or if it's the wrong thing to do. It's not. It's very difficult. It's really the easiest way to explain it is really you trust your gut and kind of really you kind of know. And in my opinion, you can't really be taught if it's an ethical behavior. You really just know if it's right or if it's wrong. And fraud again is defined here on the screen as well. And I think fraud is really easiest to understand if you think about it from people that are being deceitful or a copy of something meant to really deceive you. And generally, we see fraud in some sort of monetary gain, right? We're not normally seeing fraud as nobody being harmed. There's normally some sort of monetary rationale that's being done for purposes of the fraud. A lot of times you see it within the artwork world in the sense of somebody trying to pass off a fake Picasso or for an original when it's not really. And again, what is the whole primary purpose behind that? Generally, it's a monetary gain for the person committing the fraud. The main differences between fraud and ethics is a state of mind, right? It goes back to the whole, there's a right way of doing things and there's a wrong way of doing things. And fraud is really that execution of something that's wrong and not appropriate. And ultimately, can one be ethical while committing fraud? Well, I think maybe the case could be made that the only example in modern history that we're aware of would be Robin Hood, robbing from the rich to help the poor. So at the end of the day, what it really boils down to from an ethical to what our ethics is doing the right thing when nobody's watching and doing the right thing when the whole world is watching. And that's really what truly ethics is. And so we'll get into that in the future on a couple case presentations as well. So why do we study ethics? When you step back and you Google ethics, in just a normal Google search, there's actually over 350 million hits that come up. And a lot of these deal with the basic definition of what is ethics based on whatever hit that Google may come up with. But some of them actually are dealing with like Madoffs and those sort of interesting case studies as to people doing fraudulent, unethical type behaviors. And so it's really important that every few years that we go through and we take kind of a refresher and a step back and kind of look at various ethical items within our profession, as well as go through the rules and regulations again, just to keep us fresh and really knowing and aware of how what we do as CPAs and how that impacts everybody in the overall world. And we'll kind of go through that as we continue on in this. So as we begin this next section in talking about laws, regulations, and rules, I think it's important to provide you with your first code of the day. So this is the code, as I alluded to earlier in the presentation, that you'll need to write these codes down and in order to obtain CPE for this training. So the first code letter is I, as in igloo or indigo. Again, that's the letter I. So now continuing on with our overall laws and regulations discussion, this slide really shows the specific laws that capture under all of our as CPAs, and really the crux of these laws and regulations and rules are kind of laid out this way, that the law is written very general. So the law, for example, will say you need to have training. It's very, very high level and not very specific. And the regulations and rules kind of go into a little more granular detail and lay out what those specific requirements are from a regulation perspective. So you'll find in the regulations and the rules the specific requirements as it relates to training, whereas the laws will just say, hey, you need to obtain training as a CPA. The New York State Ed .gov is where all of these laws and regulations and rules are captured. And as you can see on this slide, there's a number of different spots on here. And this link to this website has been provided as part of this slide deck. It's www.opid.nysed.gov/PROF/CPA/CPA law.htm. And just going through these at a high level, Title 8 at the top is a link, and this is a link to all the professional laws. And this governs all of the professions that are in New York State, not just CPAs. So if you have an acupuncturist, this is where those specific laws are captured right there. There is a specific Article 149, which does talk about public accountancy, that is specific to CPAs. As we looked at earlier, there's rules. Part 29 is on professional conduct. 29.10 is specific to CPAs. And then there's the regulations as well as Part 70 is applicable to us as well. So this is kind of a good place to look if you ever want to read or familiarize yourself with additional laws and regulations of the profession. This is where those specific laws are captured. From a regulation side of the house, this is Part 70, and this is complementary to the law and has the force of the law. So basically, if you break this, you are ultimately deemed to basically be breaking the law as well. Now, as we look at this, it kind of makes sense that there's a number of definitions that are included in here in the regulation, and it walks through the experience requirements, licensing, out-of-state licensing requirements, peer review information, which has been updated and we'll touch on and further on in this presentation, CPA mobility discussions, as well as continuing CPE. As we looked at earlier, these again, Part 70 is really the regulation, and it does speak to a lot of the back that up. The rules of the law are really discussing the unprofessional conduct, and we'll get into a number of additional examples of what unprofessional misconduct is momentarily on the next few slides, and kind of walk through what the main items are in Part 29.10 that really truly define what unprofessional conduct is to the overall profession. So at a very high level, what is the definition of professional misconduct? And that's really behavior outside of the bounds of what the profession is. And if you try and violate or attempt to violate one of the rules of professional conduct, there's obviously repercussions that you will be faced with, potentially fines and maybe even imprisonment in some situations. Obviously, those would be a lot fewer and far between, but they are definitely something to keep in mind. And obviously, we should not be acting in professional misconduct. We should obviously always act in a professional manner. So, what are some examples of professional misconduct? The first bullet here really talks about the expressing of an opinion on representation in financial statements, failing to disclose material fact, failure to report a material misstatement, failure to require sufficient evidential matter, and failure to direct attention to a material departure from U.S. GAAP. So, for instance, in our practice where we normally would see that is if there's a VIE that should be consolidated, and let's say management really does not want that VIE to be consolidated within the financial statements, and we know that it should be consolidated. Everything says it should be. It's a wholly owned sub, so there's really not even any consideration from a VIE perspective, and we're comfortable with it not being in there, and we're not able to get comfortable with it not consolidated, and we go ahead and allow the financial statements to be issued with a clean report. That's actually is a professional misconduct, because obviously our GAAP would tell us we need to include that wholly owned subsidiary in the overall financial statements. So if we were to express a clean opinion, that's an example of definitely an egregious act of not really following our conduct that's professional for us as CPAs. Another example would be allowing a person other than a partner or employee to engage in the practice of public accountancy in the licensee's name. So let's say we had somebody that is not a CPA practicing with us, and they were to go through and sign an audit report that is not in their purview, like an assistant or something like that, and we were turned a blind eye to that. That would not be appropriate under our professional standards. Obviously, from a risk perspective, it would be even a worse situation, because that would be something that would be definitely not in our best interest. Now, one thing to point out here is that it's just because there may be errors or differences in a judgment. So if we have a prior period adjustment, or we have differences of opinion on GAAP or different interpretations, that doesn't necessarily mean that's misconduct. The laws and regulations don't address the fact that if there's a change in our overall judgment, that we can definitely have different judgments. It's as long as we are able to support and document those various conclusions, then we are acting within the guise of the overall laws and regulations from a CPA perspective. Issuing a report in the firm or licensee's name without the approval of the firm or the licensee is inappropriate. So, for instance, if you were to not follow the firm's policies and procedures in issuing a report and go outside of that, that would obviously be something that's professional misconduct. Another interesting one is this making a written forecast or future transaction without the appropriate disclosures. So a lot of times when we issue forecasts and projections, we're following our third-party PPC. And that's really meant not only to ensure that we're issuing something in accordance with the standards, but it also definitely maintains our professional conduct in accordance with our laws and regulations. So it's definitely important to highlight the fact that PPC does have these templates that we use in order to maintain our not only our documentation in accordance with professional standards, but also to keep us out of trouble from a rules and regulation perspective. Additionally, refusing to furnish a client request of tax returns, reports, or other documents that were previously issued or any accounting records belonging to the client. Now, this is an interesting one because we have had situations where we haven't been paid for fees and that sort of thing. So there are certain caveats on that I will caution you. If we get a call from our client that asks for a copy of their tax return, I would say generally we have to provide that to them regardless if we have back fees. There obviously are situations where certain documents may not have to be returned to them if they're behind on their fees, but I think again that really comes down to a judgment call and really a discussion that you should probably reach out to somebody in professional excellence with if you get into that situation, because it really is a facts and circumstances driven issue and something that we have to be very, very careful about, because I think what happens is a lot of times in these situations is you'll get clients that are really in an adversarial position against us, and as a result may look to really degrade our image and us as a firm outside of just the normal I want my tax return thing. So it's definitely something to be very, very careful about. Permitting any partner employee to perform any service for which the firm is not licensed to permit. So obviously you don't want me to be out there practicing yoga and holding a yoga studio here at the firm, since we are not in a position to be licensed to perform those type of services. So soliciting for or advertising for clients is deemed to be misleading. So for instance, if we have a client and we say, hey, this client has the best product out there, and we advertise it that way, that's actually not appropriate and we should not be doing it. It's misleading. We can definitely introduce clients to other clients, but we cannot really go out there and actively participate in trying to sell our clients' products to other clients. Not only is that professional misconduct, but it also gets into some of the independence rules that we have to apply as well. Failing to maintain and submit work papers. This is actually the 7-year requirement. This is the requirement that came into effect after January 3rd of 2003, which is why that date is included on this slide. So this ultimately is if we don't maintain work papers for a 7-year period, then we are out of compliance with state law. And if we're incompetent or negligent in an engagement, that is kind of a self-explanatory, then it would be a violation as well. Another example of the professional misconduct is really the competency requirements. And those are outlined on this individual slide for what is deemed to be the competency requirements. And I think it's important to note that the firm has undergone a peer review report. So being employed by the firm meets this requirement. Failing to maintain a registration. If we are not able to get we obviously have to maintain our active registration, and as a result, if we were to start practicing without a license, it would be deemed to be inappropriate, and we would obviously not be able to practice, and would be acting not in accordance with the laws and regulations of the state. Also further, it goes to if we were to reveal personal information on our clients or information without the consent of the client, that would not be appropriate as well. Now, I think one of the things to note here is that sometimes we will use analytics and also kind of benchmarking that we will share with our clients. That's actually different because a lot of that information has been sanitized in the sense of you are unable to determine which entity may have or be involved in that pool of benchmark information. So something to keep in mind is that if you do any sort of benchmarking for your clients and kind of compare them with other clients, that you're making sure that that information that can't be tied back to any of our other personal firm clients as well. So now let's start looking at some of the ethical compromises and kind of go through some various case studies, if you will, as it relates to kind of ethics and some ethical conclusions and compromises that we have witnessed. And I think before we do that, here's a quote from Woody Allen that says, "There are two people in this world, good and bad. The good sleep better, but the bad seem to enjoy the waking hours much more." So it's kind of just an anecdotal kind of funny quote to try and keep this light and entertaining. What we are going to do is we're going to look into kind of see how our ethics get compromised. And there's a number of different ways that ethics can be compromised. And they're kind of laid out on the next few slides, and we'll kind of go through them. And they're really from the ethics scoreboard. And they kind of did a study and looked at various ways and various rationales as to the ethics being compromised, and then also how people went ahead and why they did what they did, and their overall justification for the various ethical lapses that they may have encountered. The first one is the golden rule, or the golden realization, if you will. Everybody does it, so why can't I do it? So ethically, it might not be the right thing to do, but if everybody else is doing it, why can't I? So if we're all going down, we're all going down together. Another example is the misdirection. If something's not illegal, then it must be ethical. And similar to that is the compliance dodge. Complying with the rules and the laws is not the same as ethics. So if it's allowed, then it must be ethical. And if it's ethical, then it must be allowed. Another one is the whole biblical rationalization, to judge not, yet lest ye be judged, and let him who is without sin cast the first stone. So this is from John chapter 8, verse 7, which basically says we all sin, and so we're all going to go down together and all going to go to hell. Moving on, there's the tit for tat excuse. Two wrongs make it right. So if I'm getting pushed around, I'm going to fight back, because if I'm in the wrong and that other individual's in the wrong, then it must make it right. There's the slippery slope, where no harm, no foul. If nobody's hurt, then what could possibly be wrong? If it's not hurting anybody, then it's not going to be. It's not a problem. It's still an ethical. It's not an ethical issue in my mind, because it's not. Nobody's going to be hurt by this. The King's Pass, somebody's so important and has done so much and done so well in their life and done so many good things that even if they do this one thing, then it's going to be okay, because they've just done such good things in their overall life. So one example that I oftentimes will point to this King's Pass example is in the municipality world. If the mayor uses the snowplow to plow his snow, or plow his driveway as well as a driveway for, like, let's say a not-for-profit organization, well, I probably shouldn't be doing that, because it's using a government purchased snowplow to do a service, but it's for a not-for-profit, so it's a good thing, so we're going to give the mayor a pass. And that's definitely not necessarily the right thing to do, right? It's an ethical question and an ethical dilemma that needs to be addressed. The saint's license, it's for the good cause. So again, going back similar to the snowplow example, it's for a good cause. So let's look the other way. Again, it might not be an ethical thing, but since it's for a good cause, and we can all just agree that it's not really a big deal if that's how it goes, and we can all just look the other way. the futility illusion, if I don't do it, then somebody else will. So let's say you're speeding. Well, if I don't speed, everybody else is speeding. So what's it matter? Nobody's going to be harmed by this. It doesn't make it ethical, and you're still breaking the law. It's just a way of justifying it in your mind as to why it's appropriate. There is the ethical vigilantism, which is addressing a real or imagined injustice. They owe it to me. So I've been harmed in one way, shape, or form. So therefore, by doing something, it's okay. I can definitely get around it because I deserve this. There's also the comparative virtue excuse. There are worse things that could happen. I mean, if I don't do this or I do that, there's always something else that's worse. And then coming back to our friend Woody Allen, the heart wants what the heart wants. So that's another way of saying, hey, I really want this, and I really don't care if it's an ethical issue or not. This is what I've wanted, and this is the way that it's going to be, and therefore I've justified it in my mind. So those are just a few examples on how overall ethics can be compromised and will get compromised. What we're going to do now is we're going to kind of dive into maybe some individual cases that you may or may not be familiar with that have happened to individuals within New York State. These cases you probably will be familiar. You probably have heard of a number of these cases, so it might be something that's not news to you, and you may be very familiar with some of these cases. So in the first case that we have is a former comptroller of New York. This goes back to Alan Hevesi, who was the comptroller, and he ended up having to repay about $200,000 of funds to New York State. And this is an example of where he used his position of authority for his own personal gain. So a couple of things that he did is he used state employees, such as state troopers, to provide transportation for his ailing wife. And he also used his position as the sole trustee of pension funds in New York State to direct it to a friend and colleague, and then received a kickback of $1 million as a result of this. For his own personal gain. And he was sentenced to 1 to 4 years in jail and pleaded guilty in December of 2012. Another individual in New York State is Malcolm Smith. And this individual was looked to secure a bid on the 2013 New York City mayoral election. And he did that through bribery, and he was a Republican. And so he used a lot of golf tournaments and golf fundraisers to raise funds to basically bribe officials to put him on the ballot of the mayoral election in 2013. He was arrested by the federal government on corruption charges, and what I think was a lot of his demise is when he was holding these golf tournaments, he was basically telling fundraisers that you need to get in now. And if you don't get in now, it's going to cost you a lot more when I become in a position of power. And if you don't get in at all, it's really going to hurt you. So he really used his position of authority to drive and really try and become this influential person, and was obviously found out by the federal government and was convicted in 2013. As a result of that, he is actually still serving time for his punishment and is still in prison, in a federal prison down in Pennsylvania at the current time. Another case that everybody is probably very familiar with is Eliot Spitzer, who was involved in a high-priced prostitution service when he was governor of New York, and so as a result of that, he obviously threw away his very prestigious position as governor of New York as part of his evaluation back in 2008, and really was found out because of a lot of anti-money laundering provisions from the Patriot Act, and ultimately sacrificed a lot as it relates to his position of power. I mean, he was the governor of New York, which is a very prestigious position, and as a result of what his ethical lapses were, he was required to resign that and was no longer deemed to be was no longer the governor of New York. So when can ethical lapses occur? Anytime, anywhere, and really by anyone. So that's just something to keep in mind, that we have to be cognizant throughout on a daily basis, that we need to ensure that we're thinking about the various ethical decisions that we make, and just ensuring that we are being cognizant and aware of the decisions, and that there are obviously ramifications on decisions that we make. We're also going to look at some additional cases here as we continue along, and one of them is the Wes Welker case as it relates to Churchill Downs and the overpayment of $15,000 to him by Churchill Downs, and we'll get into some of the specifics earlier. And get in a moment. And I think a lot of people are very familiar with this case because of who Wes Welker was. He was obviously a wide receiver for the New England Patriots and Denver Broncos for a few years, and now finds himself on this presentation not because of his football skills, but because of some ethical decisions that he made that may or may not have been appropriate, depending on what you believe to be the case, either his opinion or Churchill Downs' opinion. So, with that in mind, here are kind of the overall facts, and I think the thought here is to kind of think through in your mind as to what would you do if you were in his situation, right? So you were basically overpaid. You made a bet, and you won, and you received this payout from Churchill Downs, and then subsequent to that, they're indicating to you that maybe, hey, we might have overpaid you some money, so we'd like our money back. So the question is, what would you do? Would you give that money back, or would you keep it? And so we'll kind of go through some of the additional criteria and facts, just to get you thinking as to what potentially may be the right decision. There is obviously no right or wrong answer in this. It really comes down to what your true beliefs are and what your ethical thoughts are, and we'll kind of go through that. So what did he do? What happened? So he made a bet on Commanding Curve. It was the name of the horse in that year, and he bet the exacta, trifecta, and super trifecta, and he hit it, and he hit it big. And so ultimately, he sent one of his colleagues to go collect on his earnings, and that person was paid out this specific sum of $57,193.90 at the cashier's window. So what happens after that? Wes Welker is very excited about winning all this money. He goes out, and obviously he is Wes Welker, so people are coming up to him saying, hey, can I get your autograph? I'm a big fan. And he says, heck with autographs, I'm going to start handing out $100 bills. So obviously mayhem will ensue as a result of people giving away free money, and security's called, and they have to usher him along and move it along because it's getting out of control, and it's just creating a very, very dangerous situation. Come to find out, officials at the track, apparently there was a computer malfunction at the time the ticket was paid out, and there was additionally some issues with the teller, and there was an overpayment of about $15,000 to Mr. Welker in the form of cash. So the entire sum of money, while he was entitled to some of it, there was a portion that he was not required or should not have been paid out and was paid out in error. So as a result, the question really becomes, what would you do? Now, your CPA, your professional CPA, does that make a difference, and are you held to a higher standard? Ultimately, some people may give the money back, some people may keep it, some people may fight it, some people may donate it. That is ultimately a question that is really the point of this exercise, to get you thinking about how you would handle that situation. Ultimately, in this situation, Churchill Downs waived obtaining the funds back and said, we hope to see you next year where you can come and gamble your money. So they did not pursue collection matters against Mr. Welker for the funds that were overpaid. Another case that's interesting is Scott London, and he is a former partner at KPMG, and he was the partner on Skechers, the sneaker company, and for Herbalife. And what he was found guilty of was he passed along insider trading information to a friend and colleague, to allow a friend and colleague to benefit from various trading schemes, if you will. His friend at the time was in the jewelry business, and it was right around 2008, and so his friend was struggling subsequent to the 2008 market issues, and so as we'll see later on, the real reason why he believed and justified it in his mind is he was just helping out a friend, and what would be the harm in passing along this information? Nobody's going to be harmed as a result of this insider trading, even though it might be illegal, or it is illegal to insider trade. In his mind, in his belief, he believed that he was doing something that nobody was being harmed with, and that it really was not an issue that ended up costing him his career at KPMG. Interestingly enough, the friend who he was passing along these trading tips to, his name was Brian Shaw, and here's a picture of him. Mr. London is on the left, and Brian Shaw is on the right, and there's an envelope full of cash. And so what happened was his friend the SEC was doing some investigating on some of these trading tips and determined that this information was definitely being traded on for insider information. So they went to Brian Shaw and said to him, if you will tell us where you're getting this information as leniency, if you can help bring down Mr. London, we'll go ahead and be a little more lenient on you. So in this instance, they set up a drop and did some wiretapping, which ended up building the case for the federal government against Mr. London. And this is just an example of a picture that they had of him doing one of these individual drops and wiretaps. So in July of 2013, he did plead guilty, and as we kind of noted here, it said that he didn't do it for the money. He did it basically to try and help a friend who was struggling in the business. He thought, in his mind, from an ethical standpoint, that he was doing the right thing, that what could possibly happen, no one is being harmed on this, but it was against the law. So as a result, he pleaded guilty, and then in July of 2014, he goes to jail. So what did he lose as a result of this? So he lost his annual salary of $900,000. KPMG also stripped him of his pension, which had grown to about $2 million. KPMG was also forced to pay some substantial civil claims as a result of this, because Mr. London was an employee of KPMG at the time. So KPMG it also impacted them as well as Scott London personally. He was fired from his position. He now has a felony conviction, and he had to serve 14 months in jail. And the question really is for what? He wanted to help his friend. He did receive jewelry and some travel tickets and travel vouchers, as well as some Bruce Springsteen concerts. So I guess he did get to go see Bruce, but I don't know if it was really worth it in this overall grand scheme of things, because obviously he went to jail and gave up all of these items included on this screen. Now, in addition to the money and the monetary side of it, he was very well respected within KPMG. He'd been there for 29 years. He was in charge of the entire Pacific Southwest audit practice. So he was very, very well respected, very high up within the KPMG firm structure. He oversaw more than 50 partners and 500 employees. And obviously, once he admitted to this and started going through the court proceedings in April of 2013, he was fired by KPMG. So again, the price that was paid by other individuals, not just him personally, was that Brian Shaw, who had to repay the $1.27 million from the 14 different trades that he had done. KPMG also was forced to resign as the auditors from Herbalife, as well as Skechers, because that's where these individual dealings came from. Ultimately, it was deemed by the SEC that they would be required to resign from the auditor. And obviously, with that breach in trust between Herbalife and Skechers, that there was not really a belief that there would be a good working relationship on any part by any party involved in that. So at this point, I'm going to give you another code letter. So that's going to be code H, as in Hilo, H hotel. So that you'll need that. So now there's been 2 codes given out at this point. So now let's jump into the specific code and the laws and regulations. And kind of as we had discussed earlier in this presentation, it kind of, the New York State laws kind of breaks up and split into the normal law, which is the top level, and is very broad, and it really just dictates well, here's what you do. And then it drops down to the regulation level, which says, kind of in a nutshell, how are you going to do it? And then there's the rule as to what to do and really what you need to be doing from that perspective in order to comply with the laws and regulations for the state as a CPA. And what we're going to do is spend a few minutes on each of these 5 specific topics right here. They're really been picked out really because they really are the ones that are mainly applicable to the firm as a whole. So obviously the firm registration process, we'll go through that for any firm, not just our firm. Also work papers, competencies, commission expense, and we'll talk a little bit about that, and then reportable events as well. And the reportable events are going to be events that you would need to report not only to professional excellence, but also to the state in conjunction with that discussion with professional excellence. So at a high level, the firm registration process is basically just that. If you are going to practice to be a CPA in the state of New York under Article 149 of the state law and the specific provision, you're going to register with New York State. So obviously the regulation is going to say, what are you going to do and how are you going to do that? And ultimately there's an application process that you're required to go through, and there will be a number of items included in that actual process and that they'll be requesting from you. And then let's not forget, there's always a fee associated with any time you deal with anything at the state level. And this is no difference if you do register with the state. There's obviously a fee that will be charged as part of that process. One of the rules will indicate that you need to maintain an active registration. So if our registration lapses with the state, we're not able to practice as a professional accounting firm anymore. So it's definitely important for us to monitor and keep in mind that if we, to maintain our license, be active from a firm perspective, because if we do not maintain an active license, then it would be deemed to be part of unprofessional conduct and subject to penalty. So overall, from a firm registration process, what's required as part of that application process? The high level on this slide is really what is required, and that's obviously a listing of all of the offices within the state of New York, as well as the main headquarters of that specific firm. The person with the authority for the firm, kind of like the office managing partners, would all be included as part of the registration process. A list of all the states in which the firm has authorization to practice, so not just New York State, but any other states that may be applicable. Any denial of the authorization to practice in any states within the last 3 years. So if we were ever told we cannot practice in a state for whatever reason, we would need to disclose that to New York as part of the application process. Also a listing of all the partners and owners, including the state with which those individual partners and owners are licensed within, has to be included and provided to the state. And this is generally updated on an annual basis as the firm makes new partners. And we're doing this on an annual basis as well. So it's kind of invisible to everybody, but it is something that is being done. Additionally, we have to list all the CPAs, and the principal place of business is New York State. So if we have partners that don't have a principal business in New York State, but are partners and owners of the firm, we would indicate that on the form as well. And then we'd affirm that all CPAs have met competency standards. And we'll get into the competency standards further along in this presentation. But at a high level, that's kind of what you're thinking initially would be your normal competency would be, are you able to perform your duties as a CPA and obtain appropriate CP and those things along those lines. And then lastly, as we kind of discussed and alluded to earlier, there is a fee to do this. So the registration fee is $50 for each office in New York State. As well, if you are a firm that is coming into New York and registering and you do not have an office in New York State, there is still a $50 fee for that. So just because you might be a Pennsylvania firm and want to register in New York doesn't mean you're going to get off the hook. There's still going to be a $50 charge. And there will also be a $10 charge for each sole proprietor, each owner of the firm that is indicated there as well. There will be a fee on that. From a work paper item, there's a couple things that we'll talk about. We'll get into what work papers are, and then before we get into that, we'll also delve into the idea of the mandatory quality review and kind of the mandatory peer review that is required under the law, which is once every 3 years. everybody, I believe, is probably pretty familiar with this, that every 3 years we have a firm come in and do a peer review of us. We just completed our peer review last year, and we received a pass report, and that's something that we have done and continue to do, and we'll do it and again in 3 years. We'll go through the process again, and this is something that is required. And the 1/1/2012 date is when it was first initially required. Now that's been subsequently changed, and we'll take a look at some of the new changes that came out in the fall of 2017 and what that's done for the various firms throughout the state of New York. So interestingly to note here, in the law it specifically says that it's a condition of renewal with the exception of sole proprietorships, as well as with firms with 2 or fewer accounting professionals. That's actually changed, and we'll look at that momentarily here as to what the new peer review law that was signed in last year, and what that means for this specific piece of the legislation. The regulation does not say that there's anything specific. It just says that you will undergo a peer review at once every 3 years. So it's running pretty similar to the law, right? Because in this instance, it's a pretty simple item to understand. It's not really complex and doesn't really need a lot of regulatory oversight or a lot of regulatory guidance. It's basically cut and dry. Every 3 years you'll have a peer review. That's it. So if we look at segueing into that peer review bill law change that we had earlier just referenced, that was effective in October of 23rd of 2017 is when it was signed. And now the new requirement is that 2 or fewer CPAs in a firm are required to have a peer review if they perform any attest work. So this means if they do any sort of audit work, any review work, any compilations, anything where the firm is required to be independent. That is the key in this instance. So if a firm performs just tax consulting and other consulting work and doesn't issue any sort of independent accountant or independent auditor report, they would not need to obtain a peer review. But for the most part, this brought into the peer review oversight program a lot of smaller practitioners that may have been doing 1 or 2 audits or reviews. And the attempt here is to really kind of push out and weed out these smaller CPAs that maybe might not have the expertise to perform these reviews and really kind of clean it up a little bit from an audit quality perspective. In addition, this law really aligned New York State with a lot of the other states throughout the country. So the purpose of it was really to make it try and be more cohesive and more comparable with other states throughout the country. There is one exemption on this. If you are only issuing a compilation report, you are not, or if your firm is only issuing compilations, you are not required to have a peer review done. And the interesting thing on this is that compilation engagements are not deemed to be an attest service under New York State regulations. They are deemed to be an attest service whenever we do an independent accountant's compilation report under the AICPA standards. However, under New York State law and regulation, it is not deemed to be an attest service. So if you do have a firm that is doing attest work, is doing just straight compilations, it does not necessarily mean that they'll have to be scoped in on this. And for any of the new firms that did trigger this new rule, or now had to have a peer review, do have until May of 2020 to comply with this new requirement under the state regulations. Looking at what the rules are for work papers, and ultimately the rule is pretty clear in the sense of failing to maintain or submit work papers in accordance with the requirements of Section 29.10 of the rules in the New York State law. It is really broken up into 5 sections. It's when is the rule in effect, which the rule was in effect in 2003. It goes through and defines what a work paper is, and we'll look at that momentarily for what is defined as a work paper within the specific state rules, and we'll also look at some of the AICPA rules and kind of the differences and nuances, if you will, between those. Also included within this rule is the documentation of work papers, and what that really means is that an individual with no previous experience or understanding of an engagement should be able to draw or understand the conclusions that you have reached as a result of the documentation of your work papers, and understand the conclusions that were reached. So obviously you often hear a lot of emphasis is placed on documentation, and this is kind of why, because it is a rule under the state law that somebody coming in with no prior knowledge would be able to review your work papers and understand what you did and the conclusions that you reached. Also within this documentation of the work papers section is the 45-day rule that indicates that all work needs to be documented and done within the binder within the 45 days. So this is where the New York State rule is 45. When you hear the 45-day rule, that is where this rule is housed right here, which is a little bit different than the AICPA rule, which is 60 days. But generally, it does not matter from an AICPA perspective, because the New York State rule is more onerous. We are required to follow the 45-day rule. A retention of work papers is important because we are required to have a policy as it relates to the retention of work papers, which would basically say that within 7 years after that, we'll maintain work papers to support our audit, our reports and conclusions for 7 years subsequent to the date of issuance, and then at which time we will go ahead and destroy those work papers because the 7-year window is up. And again, that's coming right from this 29.10 section of the rules from a New York State perspective. And then lastly, we talk about the availability of work papers to the department, and that's just pretty easy in the sense of the state comes in and asks for a work paper, that we will go ahead and comply with that requirement and that request, and we'll go ahead and give them the work papers that they are requiring. Pretty standard stuff. Now, the interesting thing is what is a work paper? And so the definition of a work paper under the rules is the licensee's record of the procedures, the test performed of information supported, and the material conclusions reached for a work product produced in the practice of public accounting. So it's a very broad item. It doesn't really indicate what that looks like. It could be a memo, it could be a work program, it could be an Excel spreadsheet. It's very broad, and it's meant to be broad for that specific reason. Ultimately, it's really anything that supports the overall conclusions that are reached as part of the work that has been performed. Now I'm going to take a moment here and kind of deviate and run away from the New York State rules for a moment, and the reason why is because a lot of times we will see and receive questions for what happens on our work papers when we not really have an adversarial situation, or let's say a client hasn't paid us, or we are being requested to provide certain documents to the client, and for whatever reason, maybe the relationship has soured, and we're trying to figure out what we can and cannot provide them from a work perspective. Now, one thing to note here is these situations are often very fact specific, and so I want to caveat this section of the presentation to really say this is really just to kind of give you a high-level overview as it relates to what these specific rules are as it pertains to the work papers under the AICPA Code of Professional Conduct at 1.400.200. If you do run into the situation where you are requested to provide work papers to an outside party, you should definitely strongly consider reaching out to somebody within professional excellence just to make sure that you are not running afoul of the state rules and regulations. And we can definitely provide a lot of guidance and help and assistance as it relates to various letters that may need to be provided, as well as provide guidance as to what we should or should not give them. And in certain instances, we may need to include general counsel in those conversations to ensure that we're all protecting the firm from a risk perspective. So 3 definitions on here are really going to drive this conversation and really drive the overall conclusions that are going to be reached. So if we just start with the first one, from a client prepared records, these are really defined as anything that the client prepares on their own to support their financial statements or financial statement information. So their QuickBooks information, anything that they're producing, Excel spreadsheets, bank reconciliations, their bank statements, anything like that that supports any of the amounts included within their financial statements are deemed to be their client provided records. And as we walk through this section of the presentation, it'll become clear as to why these definitions are relevant and important. Member prepared documents are really anything that we use to help obtain a complete and accurate set of the statements. So for instance, any adjusting journal entries, consolidating entries, or anything really that takes the financial statements from, let's say, a QuickBooks section, and we book journal entries to make the cash number right or cut off for revenue, and really make it an appropriate set of financial statements to where we can issue some sort of report on. Those are really member prepared. So when member prepared, we are the member. So for this purposes of this section of the code, member is anything that the firm, we as individuals in the firm, will produce. And then our member work product is defined as something that's set forth in the terms of our engagement. So we, as everybody knows, we're required to have an engagement letter for any service that we perform. And this is part of the reason why, because it defines what we're going to do and what we're going to provide. So it might be something as a tax return, or it might be something as a forecast or projection, or as simple as our audit report. And again, this would all be defined within an engagement letter. So paragraph 0.06 indicates that it's pretty simple. We need to return any client provided records in our custody and control of client. So let's say that we have depreciation schedules for our client, and we'll get into the web hosting piece of it further on at some point in this presentation, but let's just say we create a fixed asset depreciation schedule for them, and then our client calls up and says, hey, I need that fixed asset depreciation schedule. We are required under our AICPA professional code of conduct to go ahead and provide that to them. Pretty simple stuff. It's also unprofessional conduct on our behalf if we withhold the client provided records. So it's kind of, this rule does mirror the New York State law to a certain extent. So let's get into the areas of sometimes where we try and withhold some of our records so that we can receive money and payment for services that we have performed. And paragraph 0.07 really lays out these specific items as to when we're requested to provide our work papers, if you will, so our adjusting journal entries or our consolidating schedules. When do we have to give them back? So we generally should provide them back, as this is indicated here, and it's highlighted in red and bolded because it's very important. Except that such records may be withheld if fees are due to the member for that specific work product. So what does that mean? So let's say we're in the middle of an audit and we're wrapping that audit up, and we'll get into a couple other instances in the future too, where we can withhold it, and our client says, give me my journal entries. The answer would be, well, you still owe us X thousands of dollars, we're not going to give that to you. And in that situation, we are allowed under the AICPA standards to withhold those work standards, or withhold that work product, because it is our member prepared record. A couple other instances of when we can withhold our specific work product, so our audit report, our compilation report, any sort of report or anything like that we are, as we defined within our overall engagement letter, is if fees are due to the member for that specific work product. So if we're owed a significant amount of money for that item, we may be able to withhold that if the work is not complete yet. So if we're still waiting on a test for a search for unrecorded liabilities, and we're still waiting for the AP detail, and they say, well, I want my audit report. Well, no, because we can withhold it for that. For purposes of complying with the standards, we've got 5 or 6 open items from an audit perspective, and are still waiting to hear back from the client. So legal letters, that sort of thing. Because our professional standards require us to obtain a legal letter that we have sent out prior to the issuance of the audit report, we can withhold the issuance of the audit report until we obtain that under the specific standard, and not violate any rules or regulations. As well as if there's threatened or outstanding litigation surrounding the work that we're performing, we're not going to be forced to go ahead and issue a report that is not in accordance with any standards. If we're going to be sued as soon as we issue that report, we can definitely utilize that. I will caution you that if you do get into this situation, if a client says they're going to sue you, that you immediately reach out to general counsel of the firm to ensure that they're made aware of this potential threatened litigation, because it's definitely a big issue, and we need to be aware of that at all times. So before we jump into competencies, let's go ahead and do another code letter here. So the next code letter for CPE requirements is R as in Robert. So that's going to be code letter R for this portion. So as we kind of look at the competencies as it relates to the rules and laws of New York State and CPAs, there really isn't a lot within the law that speaks to competencies. Ultimately, the way that the law is structured is it really says you don't perform any services beyond the scope of what you're qualified to do. So in my previous example, when we had talked about me being a yoga instructor for the day when I'm not qualified to do that, the same holds true here as well. So if you are a tax expert, maybe playing in the audit field is probably not the best thing to do, because you may be deemed under the laws to have a lack of competencies. It's not saying you're not intelligent and you can't learn those specific skills. It's just saying that you put yourself and the firm at risk by performing services that you may not be appropriately trained adequately in. So if we look at the next slide, which is going to be speaking to the specific of the regulations. So again, going as a reminder, we're going from the law to the regulations, and then ultimately over to the rule if there is further clarification that's needed. The regulations really define the competencies as performing 9 specific skills that are outlined within the overall regulations of New York State. And so if you're performing any of these specific skills or competencies that we're going to go through here momentarily, you're deemed to be working and practicing in public accounting. And I think once we start looking at them, it'll be very clear to you that these individual skills are things that we do on a daily basis and really are really the crux of the firm itself. So looking at the regulation, there's 3 of them on this slide that we'll talk about. There's accounting skills, transaction processing cycles, and control environment, as well as the identification of potential violations of ethical behavior. So just stepping back to see what do these all specifically mean. Accounting skills is really defined within the regulation as the preparation of financial statements, and it's what we are normally consider our bread and butter in the sense of it's a test work. So it's analysis of transactions and how they relate to financial statements and disclosures and the application of GAAP. It's really what's covered within the accounting skills section of the regulation. Likewise, for transaction processing, that's really surrounding the ability to go in and identify a transaction and put it down on a piece of paper in the form of like a flow chart, or the identification of various internal control deficiencies or material weaknesses within a control environment. Pretty much the normal stuff that we do as part of our audit process. So as doing any of that stuff, that's just deemed to be practicing in public accounting. The next piece is kind of self-evident or self-explanatory in the sense of the identification of potential violations of ethical behavior. As part of our overall practicing in public accounting, are we able to identify ethical behaviors and provide that as a competency in the services that we do? And generally the answer to that is yeah, it's pretty commonsensical stuff. You kind of know it when it happens. So continuing along the overall competencies within this specific rule, there is the fraud detection. So for our fraud services that are performed, that is also deemed to be an accounting service, an accounting function, and there's various competencies that we have to demonstrate that if we do these in the public accounting world, there is the expectation that we are competent under the regulations of being a public accounting firm. Same goes for any business law type activities. So what does this mean, right? I mean, we're not in the practice of being attorneys. None of us would say that we are. I wouldn't think we would, but this really means that we're going to maintain confidentiality when it comes to reviewing business agreements, and we're also going to be able to read a contract and understand the advantages and disadvantages of a contract. So we can look to agreements and determine if the shipping terms are appropriate or beneficial to our client, or maybe they aren't beneficial to our client. Be able to advise our clients on those type of relationships. And so we have a level of competency as it relates specific to business law. Again, if we're not comfortable doing that, there's probably somebody within the firm that does have that expertise or the experience on it. So it's not something that would cause anybody any sort of agita, that if there's something that they're not comfortable doing, it doesn't mean we can't do it. It just means they might not be the appropriate person to do it. Case in point, tax law. Applying tax law for individuals or businesses. You do not want me out there trying to do tax advice for any of our clients. That is just something would not be qualified for, nor would I really have any interest in becoming qualified for it. Tax is something that I definitely am not anywhere near being intelligent in, and so that is what an example of a tax law would be, is just applying the normal tax law and application of local taxes or providing tax advice or payroll taxes. Application of government and not-for-profit accounting principles. So obviously somebody in the tax department might use the same scenario as me, might not want to be providing government and not-for-profit accounting advice to various clients. Again, as an accounting firm, we definitely can do this, and the expectation is that we are competent enough to do this if we provide these services, and ultimately that's really just the application of government and not-for-profit accounting principles in accordance with GAAP. Management accounting concepts, again, any sort of like cost work that's being done, so cost analysis or cost benefit analysis, and the same with like the financing concept is ultimately included in there as well, is if we're able to look at transactions and look at management efficiencies and analyze costs and make decision-making type activities for our clients, that's something that we can do as long as we have the appropriate level of competency for those specific procedures and services that we're providing. So that's kind of at a high level the overall competencies, so under the regulations. So now if we look at the specific rules are really, if we are surrounding more of time more than anything else. So ultimately the rules will look to say, if you are supervising an engagement, so if you're in the attest or compilation services and you're overseeing it or authorizing somebody to sign that signature, you need to have had 1,000 hours of experience within the past 5 years, or be employed by a firm that has undergone a peer review within the last 3. So this kind of goes to, why are we able to hire individuals that maybe have been in private for a number of years? Because we have had a peer review, so therefore that they would meet the competency requirements under this specific standard. In addition, this kind of speaks to the overall CPE that is required. So you would need 40 hours of CPE during the year that you're performing the specific service, or 40 hours of CPE in each individual year that you are performing the service. So that makes a total of 120 hours for the 3 years, and we'll get into that in a little bit more detail momentarily when we speak to the continuing professional education requirements under the state laws and regulations of the Department of Education. So let's say we are in a position where we're deemed to be, it's determined that we were negligent. I'm not going to use the term incompetent as it is on this slide, but let's say we were more negligent on the services that we provided. What really is going to happen? So we violate this law. So if we go back to the example of, let's say somebody does perform a service that maybe they don't have the appropriate skills and expertise to be providing that service. And what the Department of Education and the Education Board of Regents and everything is going to look to is really, did you violate the accounting standards from a GAS and GAAP perspective? And those are going to be promulgated by, as everybody's aware of, the AICPA or the FASB, and potentially where you do practice in PCAOB world or other different accounting infrastructure. IFRS comes to mind. Those would be the ones that they would be looking to determine if there was a violation from a competency perspective. So it's just something to just keep in mind from a competency perspective, that is, when we're going through our documentation, you'll hear a lot of it. A lot of times, and as we alluded to earlier in the presentation, if our documentation is there from our conclusions that we reached, somebody can always question our judgment, but if our judgment's documented and well thought out and sound, we generally will be able to come over we acted in a professional manner, and the unprofessional conduct standard would be very difficult to prove, just really given the fact that we are following our normal accounting standards and practices, and therefore it really shows that we are doing a quality job from a work perspective. So if we segue into the CPE world, these next couple slides are going to be pretty lame, because they really don't tell us anything. Ultimately, the requirement is, from a law and regulation perspective, is that you need to get mandatory continuing education. That's it. So, okay, so great. So that's what the law says. What's the regulation say? The regulation pretty much says the same thing, that every 3 years you need to complete continuing education requirements. So you sit there and you wonder, well, what does that mean? Obviously, I'm sitting through this ethics class, and now I've got my 4 hours of ethics, so now that counts towards my 120 hours, but where's this whole 120 hours classification coming from? And ultimately, the 120 hours is really coming from these specific competencies, specifically within the rules of the law. So the 120 hours is determined based on a 3-year period. So it's 40 hours in every year. So ultimately, in order to maintain your CPA license, every year you need to obtain 40 hours of CPE. So at 3-year triennial renewal period, 40 hours in year 1, 40 hours in year 2, 40 hours in year 3 gets you to the 120 hours. If you have an inactive license and now are coming back into practice, you are required to obtain 40 hours of CPE in the first year that you are performing as a CPA. So let's say you leave public accounting in 3 years and then come back to the firm. In your first year back, you would be required to obtain 40 hours of CPE for your license. And then subsequent to that, under the next renewal period, you would probably be required to get up to your 40 hours in year 1, 2, and 3, back to the 120 hours to get your license active again. And so one of the items that is deemed to be unprofessional conduct is if you don't maintain your CPE and you fall behind from a continuing ed perspective. So I know there's a big onus and push near the end of the year to get your CPE and to make sure that you're getting your CPE. And the real rationale as to why that's being done is because it is deemed to be an unprofessional act under the laws and regulations of the state of New York. And so it's taken very seriously by the state. And as a result, we try and make sure that any issues are addressed prior to that year, so that everybody's in compliance with that 40-hour minimum requirement each and every year, so that it's easier to get the 120 at the end of the process. One may wonder and say, well, let me gamble and try and get away without having to do the 40 hours or the 120 hours. There are obviously some smaller practitioners that will not meet the 120 hours of CPE or the 40 hours in a single year. And oftentimes the question comes up, well, how's the state going to know, and how am I going to get caught? Well, there's a couple ways that the state will find out. And the first is when you fill out your application, you indicate that you've met your CPE requirements right as part of the application. So it's strictly right on there. You're putting down that you have had 120 hours of CPE credit in the 3-year period. You can always have more, but the minimum is the 120 hours. Also, the other way that the state finds out about this is the state will oftentimes do random checks, or random audits, I should say, where they'll send a letter to you asking for your records of the 120 hours of CPE. So you have to send all that information in and prove to the state that you do have the appropriate number of hours to CPE to maintain your license. So it's kind of a twofold test that they're running to determine what you have from the CPE perspective. So segueing now away from the CPE world and over to reportable transactions, or reportable events, I should say. This really gets into what events do I have to tell the state about? So do I have to tell the state that I'm behind on my CPE? Or do I have to tell the state that I've been convicted of a felony or something along those lines. And those are the specific things that we'll talk about momentarily here. But interestingly enough, similar to the CPE requirements from a reportable transaction, the law doesn't say anything about what has to be done, what has to be reported, or anything along those lines. Same with the regulation. There's really nothing in the regulations that say, hey, I have a reportable event, or what is a reportable event, so what do I do about it? There's nothing that speaks to it. However, within the rules, there is a specific item that does say what you have to do, and that is if you are convicted of there's three main events that really drive what is deemed to be a reportable condition, and those three items are if you've been convicted of a felony. So if you murder somebody, you got to tell the state that you've killed somebody, or you've sued and you've settled an action against you. A class action lawsuit's been settled against you in excess of $25,000. So you've taken it through the full court proceedings and ultimately lost. And the judgment was against you that was greater than $25,000. Or there's a disciplinary action or penalty taken against you by the U.S. government, generally you would see it through the SEC. Those are the three main items where, or another, I should say, back up for a second, or any other regulator, so PCAOB or even the AICPA, if there's a disciplinary action against you based on that. These would be reportable actions under the state rules. What do you have to say, or what do you have to report up to the state is kind of the next question. So let's say you do unfortunately receive a judgment against you for whatever reason by the SEC or something along those lines, and let's hope that this never happens, and this is really more of an informational discussion more than anything else. And you have to report up what the decision, or provide the state with a copy of that court decision of the conviction, if it is a felony, or a copy of the report if it is a disciplinary action, as well as the potential of a class action lawsuit if that is against you and you've lost. You have to provide that to the state. The one caveat there is that if it is deemed to be a confidential treatment, so let's say it is a confidential activity, you would not be required to report that up to the state because it is confidential, and you would not be deemed to be out of compliance from a reporting of a reportable transaction. You also would need to indicate what the disciplinary penalty is, as well if there was any arbitration findings, and if the report that you're providing to the state is not in detail enough nature, a short description as to what truly happened, or what was the event that led to the overall findings. The next question is what happens if there's no report that's ultimately filed? That's really deemed to be an unprofessional conduct and conduct detrimental to the profession, and so there may be additional proceedings held against you by the state of New York as part of your license. So we're also going to talk about the rules and interpretations for the AICPA in a little bit, and I think at this point it's a good position to come out and kind of give everybody a high-level understanding as to what is in the AICPA interpretations, and really what does integrity that we've been talking about really mean to the overall profession. And the AICPA Code of Professional Conduct really starts out under ET 1.100.001, and it really just ultimately says that that as a CPA, they use the term membered or covered membered throughout the Code of Professional Conduct a lot, and we'll go through that in future slides as well. But it really is this term that the member, so ultimately anybody that's a CPA, shall not knowingly misrepresent and have a misrepresentation of the facts. And what that's really saying is that as CPAs, we cannot be issuing items or presenting ourselves out as experts that we're not, or a very number of other rules. But in the very narrow definition here is it really says if we issue a report or a tax return, we can't be excluding subsidiaries. We cannot be keeping individual entity's income out of the tax return, we have to knowingly represent the facts of the specific situation, and really ensuring that as CPAs we are being as neutral as we possibly can with regards to the work that we're performing. Next, we're going to shift over and kind of look at the New York State regulatory environment as well as the New York State Education Department. And what's on this slide really is just a high-level overview of the operating structure, if you will, of the New York State bodies that oversee us as CPAs and accountants. There's on the next slide, there's some more granular data that I'll kind of just walk through on this slide, and really the rationale for me doing it that way versus flipping to the next slide is it kind of is a little bit easier to see visually here versus in the next few slides. It seems in my mind to make sense. So just bear with me as I go through this. At the top of this is all over underneath the Department of Education's purview. So at the top of the Department of Education in New York State is the Board of Regents and Commissioners. And as you may be aware, this entity oversees the state state university system. So if anybody went to any state schools, this was kind of you have a diploma that says from the Board of Regents of the state of New York, and that's kind of obviously because they sit on top of all of these various SUNYs, and they also oversee the Office of Professions, which is the next level down. And there's 48 different individual professions that the state will monitor and oversee. And as part of this, the role of the Office of Professions, if you will, is really to determine the qualifications for that licensee. So obviously for us as CPAs, they'll look at our education experience, any administration of any examinations, such as the CPA exam, the bar exam, or any medical boards that may have to be taken. Nursing also is included in here. And they'll also look at experience requirements to make sure that the individual that is looking to be qualified for a license has the appropriate level of experience to be able to obtain a license in the state of New York. They will process license applications and issue credentials, and they will also pull credentials if it's deemed appropriate. The registration process will also be part of the Office of Professions. And online, you can actually go through and confirm if an individual is or is not a CPA through the Office of Department of Education and through this Office of Professions. They have a database that's set up for all 48 individual licensing entities that they oversee. You can actually go on there and type somebody's name in, and it will tell you if they are or are not licensed within the specific section or area of where they're practicing. So if you go on there, you will be able to see yourself if you are a CPA, and it'll indicate when your license is up. So if your license is up, obviously you need to rectify that situation. But it'll also tell you if you forget when your license is coming up. It'll indicate on that website, hey, my license is up in, let's say, November of 2020 or whatever the case may be, so you can kind of plan accordingly. The Office of Profession also will oversee to a certain extent some of the case matter of the Office of Professional Disciplinary. So it will discipline individual professionals, with the exception of they will not do doctors or lawyers. There are separate committees for those two individual sections. So doctors and lawyers are exempt from their oversight. The Office of Professional Discipline will investigate with the assistance of individuals throughout the firm and state board members. So the Office of Discipline will report into the Office of Professionals as well as to the Board of Commissioners for disciplinary actions. And then there's also to the left of there, also to getting away from the Office of Profession to a certain extent, is the State Board of Public Accountancy, and that's really more of an advisory type position. So they will advise on various matters as it relates to licensing, as well as certain laws and regulations. So that's kind of like at a high level the overview from the state of New York as to how the different bodies work and will involve themselves. And then obviously underneath that there's a secretary, executive secretary for public accountancy. And again, this is the slide. These next couple slides, this one right here, again, just speaks to what I spoke to with regards to the overall operating structure. And then this slide right here is speaking to a lot of the information as it is talks about from the role of the profession.